Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Barb Armstrong, who is a great educator in her own right. She is there to help answer your questions. She's filled in on this webcast for me on a couple of occasions, so I'm glad to have her here with me in this discussion. If you're here with us, whether you're in the live version or the recorded version, welcome and thank you for being here. If you're here in the live version, be a part of the conversation by chatting in a question. Barb will grab that. I will grab that as much as we can. If you are in the recorded version, leave us a comment in the comment section. And of course, we'd love to have you subscribe to our webcast series, as well as click on that like button if you happen to like what you see today. And welcome to our usual suspects. I know we've got a number of new folks here as well, so I wanted to answer a couple of questions along the way. But we're going to jump in here really quickly. A couple of quick housekeeping items. Remember that everything we can talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation. Remember, the past performance, no guarantee of future results or success. Trading equity and index options carries a high level of risk. It is not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that when you are long an option, there's the potential to lose everything you've invested in that option. We'll talk about that when it comes to index options here in just a minute. Also, remember that when you are short an option, if it is an American style option, there is the potential that you might be assigned the obligation that entails early. Now, index options, at least the ones that we're going to be talking about today, are European style, the ones that we will discuss. There are some that are American style. But European style index options do not allow assignment or do not allow exercise by the buyer of those options until expiration. And that takes away that early assignment risk. That's one of the differences between an equity option and an index option, is the lack of early assignment risk. Now, we'll talk through that as we get into those specific circumstances, but all the other things that go along with and that we talk about on a regular basis here from a disclosure standpoint still stand. We don't recommend the use of technical analysis as sole means of investment research. We're going to be using the Thinkorswim desktop software platform. It's not a guarantee of future success out there in the real world. It's a great learning environment. It doesn't do certain things that a live trading account will do. So, as we get into this discussion today, I wanted to talk a little bit about what index options are in comparison to an equity option. And a couple of people have asked me the question, well, what is this thing, this index option thing of which you speak? And the idea is that any option contract has an underlying symbol or an underlying instrument that it derives its value from. That's why option contracts are called derivatives. So if I've got, let's say, for instance, I'll just pop a different stock in here. I'll just pop Apple, APL, here into this particular chart. That's my underlying stock. And if I come over here to the trade tab and I go to Apple, AAPL, the option contracts that are listed are basing their value and their rights and obligations on the value of Apple as a symbol, as a share of stock. Remember, each of these contracts represents 100 shares of stock for standardized contracts, which means that if you are long, if we were to go, say, for instance, to the 19 December option, and we were to buy a 19 December call option at the 260 strike, we've got the right to do something. We've got the right to buy the stock, Apple, at $260 a share between now and expiration, which is the 19th of December. And for that, we're going to pay a premium, $15.50. You should all be familiar with that option basic mechanics by now. That is something that Barb Armstrong talks about in her Getting Started with Options series, something that we talk about in our option strategies live workshops. But that's the basic mechanics. but the settlement and the settlement value and what it settles to in terms of that contract. If you were to hold on to this contract through expiration and you were in the money, meaning it had intrinsic value, this option contract is going to settle to long shares of stock in your portfolio, meaning it's going to be, in most cases, in the vast majority of cases, it's going to be exercised at expiration, and you're going to be the proud new owner of 100 shares of Apple at $260 a share. And likewise, if you were, say, for instance, long a put option that was in the money. Let's say we were long the 280 put and the price of the stock stayed where it is. This option goes all the way through expiration. We're going to be the proud owners of a short position of 100 shares at the 280 strike of Apple stock, because that's the underlying symbol or the underlying contract, the underlying mechanism. But that's an equity. And so we have to then think about what owning shares of stock or being short shares of stock entails. That entails risk. That risk is that you now own the stock, or you have a short position in the stock, and the price of the stock could move up or down. And that's position risk that you now have because of what that option contract turned into. But the difference, if we were to take this out of the equation, we were to go back over here to the chart, we were to put this back to SPX, is now if we were to trade an option on this index. Now remember, an index isn't an underlying stock, nor is it like the construction of an exchange traded fund. It is not a basket of underlying stocks like an ETF, like an exchange traded fund. Now, I'm just going to say this, we're not discussing ETFs. We're not talking about specific ETFs. If you're going to trade ETFs, make sure that you are aware of the characteristics, risks, charges, and expenses. Make sure you read the prospectus before you trade any of those products. So an index, on the other hand, is simply a measurement. It's a measuring tool. If we were to go, say, for instance, to the Market Watch tab, and we were to go to our visualize sub-tab, and I were to go to the S&P 500, which is the SPX, I can see all 500 of the shares, or 500 of the stocks that are in that S&P 500 index. If I were to go to the Russell 2000, I'm going to see all of the stocks that are in that index. If I were to go to the NASDAQ 100, I'm going to see all of the stocks that are in that index. Those stocks make up the value of this index, the SPX in this case, or the NASDAQ, or the Russell 2000. It makes up those values. That composite of all of those prices gives us whatever that index might be, and in whatever component weighting it might be. So the SPX is a cap weighted index. There are some that are equal weighted indexes. There are some that are market weighted or price weighted indexes. But all of these indexes are simply measuring tools. They're just collections of prices. There's no underlying stock, because the SPX itself is not a tradable instrument. As a matter of fact, if we go to the trade tab and we type in SPX and we keep our option grid closed here, or option chain closed, I can't click on that bid or ask without getting this flag that says instrument SPX is not tradable. I can't buy or sell the index. So if I trade an option on the index, let's open up the option chain. And let's say I go out here to 34 days to go until expiration, the 9th of December, and I buy an index option. Here's what I'm buying, because if I go down here to, say, for instance, the 6810 strike, if I buy this index option, I'm not buying the right to buy the index at that price or sell the index if I'm buying a put option. I'm buying a movement around a particular price. So the strike price is still the same, right? It's still the same idea. It's the price at which we do the deal, but these index option contracts settle to cash. Meaning at expiration, if we hold these all the way through expiration, These contracts, because all time value or extrinsic value is going to be gone, these contracts at expiration will be worth one of two things. Period, end of story. One of two things. They will be worth intrinsic value or zero. That's it. Intrinsic value or zero. You don't end up with a long stock position because there is no stock. You don't end up with a short stock position because there is no stock. You end up with cash in your account or nothing. That's how an index option works. So somebody asking the question, well, why is that an advantage? Well, barring significant adverse movements in the US dollar, if you get a dollar-denominated cash payment into your account, that has significantly less potential position risk than an underlying stock that could move in a much more volatile fashion. Now, for sure, the value of the dollar can move. That's not, we're not saying that it can't. But it is a significantly, I think, simpler mechanism to just think I've got cash in my account versus shares of stock, and in terms of managing what these trades ultimately end up with. So if we were to do this and we just simply change our layout here to intrinsic and extrinsic, here's what we know is that at expiration, this contract, this 68.25, if it were to stay right where it is, that's going to be worth $126. Actually, I'm sorry, that's going to be worth zero. The 68.20 is going to be worth $4.20. This one's going to be worth $14.18, $24.18. You can see how that's going. That's the cash times 100 units, because I don't think it's fair to say this is 100 shares, because it's not really 100 shares, but it's units per contract. Does that make sense? So that's kind of how the difference between an index option and an equity option works in terms of settlement. So those are some of the most significant differences. There are other differences, and we'll talk about those along the way, some that we can really delve into and some that we can't. Sometimes, and I will just preface this by saying that I am not a tax advisor. I don't even play one on TV. But some index options provide different tax treatment when it comes to things like capital gains than equity options. So something that you might investigate with your Schwab branch financial consultants or a tax advisor that you trust, delving into those aspects of index options. But as we start to look at these index options, as a matter of fact, we've got a bunch of watch lists. If we go to the Market Watch tab and we change this from visualize to quotes, and then we change our watch list down here to our public watch list. If we come down here, say for instance, to European style indexes, we'll just come right here and go European style indexes. Now we've got a list of indexes and we can sort these alphabetically. Oh, let's go the other way. There we go. There's alphabetical. We can sort those indexes alphabetically. You see the name of the index or the symbol. You see what they describe or what they're talking about or what they measure. And then you see other values around these indexes. So these are European style indexes. These are ones that do not allow exercise of that right that the option contracts give until expiration. So if we're the seller of an index option, we don't really have to worry about that early assignment risk, because early assignment can't happen. Early assignment or assignment only happens at expiration. So one of the hallmarks of trading index options may very well be that it allows us the ability to trade potentially closer to the at-the-money position if we're being a seller of an option, and closer to expiration, both points at which, if we were trading equity options, might put us in a position of being in a higher likelihood of being assigned early. So that may be another benefit, potential of trading index options, but it comes with some risks for sure. So Jonathan asks a question. One of the key differences of an index option is basically you are buying the 100 units for that contract of whatever index, right? Knowing you will own it at expiration. So knowing that you're either going to get cash or no cash. That's the thing, right? Now, that's if you were to let that option contract go all the way through till expiration. But by and large, we're going to buy a contract and sell it, or sell a contract and buy it, and not necessarily let it go all the way through until expiration. So simply buying when it's cheap and selling it when it's dear, or selling it when it's dear and buying it back when it's cheap. Those are the ideas behind trading options generally. So you can see that there are a lot of things we can choose from. So some of the index options that we use on a fairly regular basis in this particular class. So okay, before I get to that, if I ask a question, why is SPX European style? And it has nothing to do with politics. It has nothing to do with country borders. It's just a reference to the style, right? It's like calling something old-fashioned, but it has no connection to being old, from olden times, right? It's simply a means of denoting a particular type of mechanism for that option contract. There's no political implication there, Taya, from that European style, right? It just simply says, okay, those that are denoted as European style indexes can't be exercised prior to expiration. Those that are designated as American style can be exercised prior to expiration. You could call them A and B if you wanted to. The European and American doesn't matter. It could be A style and B style, right? Whatever. Okay, cool. Good question. I think that's a really good question to ask, though, because it makes sense, right? Why would it be referred to? I mean, this is the index here in the U.S. markets. Why would that be a European style option? So, good question asked. All right, the ones that we primarily use, and you'll primarily see us talk about, and you'll hear about these on the news, and you'll hear it on the radio, and all of those things are the S&P 500 index, the SPX, the NASDAQ 100, NDX, and the Russell 2000, the RUT. Right. So these are the primary market indexes. You will also have indexes on the Dow Jones. We don't oftentimes use it because it's a smaller group of stocks. You'll have all of those other indexes that we looked at there in that watch list that measure different things. You look at those that measure the utilities, the volatility index, the airline index, for instance. So you've got a lot of different indexes that measure different things, that have different measures, foreign currencies, all kinds of things. The ones that we primarily use to measure the metrics of the market are these three market indexes. Yeah, so David asks a great question. So if I'm trading index options, is that the same in terms of notional value, in terms of the value of the contract as, say, for instance, a futures option trade? And yeah, there is kind of a trade-off there, right? Kind of a percentage basis. But they are not the same thing. A futures contract is something that is entirely different from an index option and from a share of a stock. If you want to learn a little bit more about what those futures options consist of and what they reflect, again, those futures contracts are going to take their value. Those are tradable instruments, but they're going to take their value from the movement of the index, the same components, if they're index futures. But if you want to come and talk to me about and ask that same question when we get to my Tuesday morning futures class, great question to ask. Tuesday morning, market open, I teach trading futures as a webcast, and we talk about similar things. So there's a couple of things that I wanted to go through in this discussion today, since I know that we have some, like I said, I know that we've got some brand new folks, and I know that we've also got some traders that have been here and some viewers that have been here with us on a regular basis. First of all, I just want to say this. This is a good reminder for me to remind you to click on that subscribe button down at the bottom of the page if you haven't done so already. I'll tell you why. I'll show you why in just a few minutes. The other thing I ask is if you wouldn't mind giving us a follow over on X at Ben Watson CS and at Barb Armstrong CS. And then if you happen to like this webcast, just click on that like button, and that's going to help to pop this content up to the top of that algorithm. But let's take the example, say for instance, of this SPX. And let's take a look at what's going on today, just kind of a measure of what's going on in the market. So I've got the trend line here. I've got my 50-period moving average. I've got a 200-period moving average. Both of those are moving higher. We get a little bit of a bullish bounce today. We've had 1, 2, 3, 4, 5, 6 downward candles. Now, they've been downward candles just in the sense that they've been red candles. They've kind of been going sideways. We had a little bit of a gap up, sell off, gap down to this open and sell off, gap up, sell off, gap up, sell off, gap down, sell off. And now today we have pretty much an open and a little bit of a rally. So we've had some down days in the last little bit. Now we seem to be bouncing up off of a level of support. Now, here's the thing. Again, remember, this is not a tradable instrument. So it's not the SPX that is doing this. It is the components within the SPX index that are moving in a particular direction, right? So you've got some leaders, some laggers. You've got some in this index that are moving higher, some in this index that are moving lower. Let's see what's driving this index today in the S&P 500. It's NVIDIA, it's Micron, it's Google and Google, it's Tesla, it's STX, it's Lilly. This is a cap-weighted index. So the bigger stocks, the bigger capital weighting or market capitalization weighting stocks are going to drive the index to a greater degree. So those boxes here that are larger, when those are brighter green, that's really driving this index. Some that are weighing this index down, Microsoft is weighing it down, Home Depot is weighing it down, Apple's kind of neutral today. Those bigger boxes having a bigger influence. That's how we look at this on this visualized chart. So we're seeing the SPX kind of moving a little bit higher here. So if we were going to use an index option to take advantage of this particular movement, we could do a couple of things. We could come over here to the trade tab for the SPX. And we could say, fine, I just want to take advantage of that bullish potential movement, that bounce up off of that support level by buying a call option. Remember, call options get more expensive when the price of the underlying instrument goes up, right? Call up, put down. Calls get more expensive. So I'm just going to use the same methodology that I would use for a long option, for a long call option on an equity. And by the way, our good friend Rachel Dashel teaches the long options webcast. I think she teaches that on Tuesdays. And she does a phenomenal job with that, talking about long options. If you want to look at that webcast, she does a great job. So I'm going to come out here. I'm going to go out about 43. I'm going to go out to the 19th of December. 44 days to go until expiration, 19th of December. By the way, 19th of December, Barb Armstrong and I will be in Miami, Florida at the JW Marriott Turnberry, because the next day we're going to be teaching the advanced options live workshop, the 20th and 21st at the JW Marriott Turnberry in Aventura. Come and join us. It's going to be a great time. But if I wanted to take advantage of that upward movement, I could come in here and I can buy a call option. So I'm going to come down here. I'm going to go like we did before, go to that 68.10 call option. I'm going to buy that for $164.20 per share or per unit, right? And if I click on confirm and send, that cost is going to be $16,420. Pretty expensive. That's the challenge, though. These index options can be very expensive, especially with a big index like this or the NASDAQ. They can be pretty expensive. So that's $16,000, but I've got the potential for infinite maximum gain. The index could theoretically go to infinity, but it's probably not going to do that in 44 days. But we get seduced by that and thinking, cool, yeah, it's going to go that far. Maybe not. What we could lose in this particular trade is what we put into this trade, and that is the 16,420. Because remember, at expiration, this option is going to be worth intrinsic or nothing. Intrinsic or nothing. So yeah, so we could do a call spread to reduce that cost. Now, here's the thing. Let's see how we might construct that call spread. We might say, okay, cool. I think that this index is going to go a little bit higher here. So I'm going to create a call spread that gives me the advantage of that upward movement. And maybe I want to reduce the cost a little bit. I'm going to limit the gain in the trade, but I'm also going to limit the cost in the trade. So I might buy that 68.10 call, and I might at the same time sell, say, for instance, the 68.30. I think that the index is only going to go to 68.30. Or I'm willing to give away any upside move above 68.30. And now I'm creating a long call vertical spread. By the way, we've got, I think it's Barb Armstrong. I think, Barb, you teach the long vertical spreads webcast. It might be Brett, but I think it's Barb. I'll have Barb remind me of that. But notice that that's going to only cost us $12.55 per unit or per share. We'll click on confirm and send. And our cost now is $1,250. That's our max theoretical loss in this trade. And our max gain is not infinity. It is $750. So limited gain in the trade. But we've reduced our cost. And we know that at expiration, this spread, this long vertical spread, is only going to be worth intrinsic or nothing. Intrinsic or nothing. And so, again, it's that definition. And here's the other thing, though. Ideally, if we're trading a long vertical spread like this, where we've got a short leg, the one that we sold, in this case, the 68.30, if we're trading a long vertical spread on an equity option, there is the potential that that short option, the one that we sold, could be assigned to us early, in which case it would put our option spread into a theoretical maximum gain scenario. That possibility does not exist here in a long vertical spread on an index, because you don't have that, as long as it's European style, you don't have that possibility of early assignment. So some traders like trading long vertical spreads simply because early assignment puts them potentially in that position of taking long. Oh, Cameron May, thanks, Barb. I appreciate you grabbing that. But an early assignment in a long vertical spread puts them in that position of being maximum theoretical gain. So some traders then, on the other hand, might, if they're trading index options, shift their thought process over to being the seller of a vertical spread. So if I'm the seller of a vertical spread, and I expect that the price of the stock is going to go up, I might come over to the other side of the equation and I might sell, say, for instance, the 6,800 strike, and I might buy the 67.90, and now I'm bringing in a credit up front of $334, $335, but my max loss is $655. Now, some traders, when they're trading equity options, may hesitate to trade short vertical spreads, is now taught by Brett Crowther. Because early assignment in a short vertical spread puts us potentially into a theoretical maximum loss scenario. But we don't have early assignment risk in a European style index options. So that's where those traders who maybe like the idea of getting paid up front and taking in that premium and using this for income generation or for hedging or offsetting may prefer using index options to eliminate that early assignment risk. And that may be one of the benefits. Now, that brings me to this next strategy that we've been doing for a while in this particular class. We've been doing it for over a year now. And that strategy is using what we know about market movement, what we know about index options, what we know about implied volatility, and time decay to take advantage of directional movement on an ongoing basis. So I'm going to go over here to the monitor tab really quickly. For those of you who are brand new, pay attention. For those of you that have been doing this for a while, you know that what we do with this, and we've done it again and again and again. We do it every week. But the strategy is simply this, and I'll bring my scratch pad over here to the left-hand side. We sell a vertical spread at 14 days till expiration, and we buy it back at 7 DTE. Come what may. Okay, so here we are, 7 days to go until expiration. We sold last week the 6660 put, and we bought the 6640 put. 20-point wide vertical spread. Now, here's what tells us whether or not we're selling a put spread or selling a call spread. If we're bullish on the index, we sell a put spread. If we're bearish on the index, we sell a call spread. So we're bullish still on this index, so we sold a put spread. Remember, we're using that short put vertical spread in a bullish direction. So we sold it originally for $2.20. It's now trading for $1.65. So it's made a little bit of money for us. Not a lot, but it's made some. Ideally, this would get closer to like 20 or 30 cents. And we've had a few of those where we've taken the majority of the gain that we could make in the trade. But in this case, we're not making very much on it, but we're going to buy this back regardless, because that's what we do. We buy back at 7 days till expiration, come what may. So I'm going to right click and I'm going to create a closing order, and I'm going to buy back this vertical spread, and I'm going to try to buy it back for $1.70 out of the $2.20 that I paid for it, and I get to keep a little bit of gain. So I'm going to click on confirm and send. We're going to read through this order, make sure that it is to close, and I'm going to click on send, and we're going to fire that order off, and we bought it back for $1.70 against the $2.20 that we brought in to begin with when we started the trade. Now, here's what we're going to do. We're going to go over to our charts tab once again. We're going to keep this in place. I'm going to continue to add to kind of this scratch pad, if you will, scratch pad trading plan over here on the left-hand side. So if you want to write this down, you can do this. This is the basics of it. Sell a vertical spread at 14 days till expiration, buy back at 7 days till expiration. I'm going to change my grid here to our index options grid, which means I've got two charts side by side in this view. I've got a longer term chart and I've got a shorter term chart. The longer term chart is a 1-year daily chart. The shorter term chart is a 3-month, 1-day chart. So the blue line on the longer term chart is a 200 period moving average. Here's what we do in this case. And again, this is simply an illustrative example, not any kind of a recommendation. So this is if price is above 200 SMA, then sell put spreads. If price is below 200 SMA, then sell call spreads. Okay, that's the simple definition of, are we bullish or bearish? Are we bullish or bearish? Price is above the 200 simple moving average, sell put spreads. If it's below the 200 simple moving average, then sell call spreads. Now, what we're going to do is we're going to go out 14 days till expiration. And I'm going to go to my trade tab really quick, and I'm going to close this, and I'm going to say, all right, where's our 14 days till expiration? It is right here. It is the 19th of November. By the way, 19th of November, I'm going to be driving to Anaheim because we're doing on the 21st of November? We're we're doing a market drive in Anaheim, California, at the Anaheim Marriott, which is just right down the street and in the shadow of the mother park of Disneyland. So come and join us for that. Barb will put that in the calendar here as well in the schedule. So we're going to go to this one. We know that that is 19 November. So what I'm going to do is I'm going to go back to my chart and I'm going to change this time hack. This time hack that I have here is a drawing tool. I'm going to go over to the shorter term chart. It's a drawing tool called a time level. So I'm going to change this to a time level. I'm going to delete this one and I'm going to come out here to the 19th of November. There it is right there. And I'm going to click. There's my 19th of November time hack. And I'm going to say, look, where is the crossover between 14 days from now and this curve that represents one standard deviation? Somebody asked me the question the other day, what's one standard deviation? One standard deviation is just simply the typical range that the majority of the prices in that time frame are going to be. So that's the typical range of movement. So I'm going to draw my line where those two intersect, and I'm going to call it, in this case, 65.90. That's where my intersection is, 65.90. So what I'm going to do now is and you can see I've left these in place each time from where we've sold these. So I'm going to come back to the trade tab. Now we're going to go out 14 days till expiration, draw a line. At 1 SD crossover. Okay, so where it crosses one standard deviation, we're going to draw a line. Now we're going to come down here and we're going to sell. Let me make that a little bit bigger so you've got all of those. We're going to go back to our trade tab, 14 days till expiration. And we know that that was, where was it? Did we say it was? I don't know where it was. 65.90. 65.90. We're going to find that strike. Where's our 65.90? It's right here. So we're going to sell the 65.90 and we're going to buy the 65.70, 20 points wide. Now, you can do 10 points wide. You could do whatever increments you want to. I'm using 20 points wide so that we are consistent. Sell 20 point wide, put vertical. Okay, we're going to sell that 20 point wide put vertical, and I can bring in right now about $1.90. Implied volatility's fallen a little bit today. So I'm going to sell that one at that crossover. We're going to click on confirm and send. We're going to read through this order. It's to open. We stand to make in this trade $1.90. We're not going to probably get maximum theoretical gain in this trade. We're going to probably get a percentage of that. Our risk in this trade is $1,810. I'm going to put this in our index options weekly group, and we're going to go ahead and we're going to click on send, and we're going to fire that order off, and we got it for $1.90. Now, I want you to look at something here. I'm going to change this layout to delta, theta, and vega. So I just sold the 65.90 strike, which is about a 15-cent delta. 15% probability that this option is going to be in the money at expiration. The reason I'm going out to one standard deviation is this is a high probability trade. The reason I'm willing to take an $1,800 potential maximum theoretical loss is because this is a high probability trade. Once in a while, we'll end up taking a maximum theoretical loss, right? But this is simply looking for the stock to be not where we sold this vertical spread, or the index to be not where we sold this vertical spread. So that's why we're creating it the way that we do. Now, someone asks a question, where did it get that line, that probability of expiring cone? It is simply a study in the study sets. We go over here, maximize the cell, we'll click on that, and it is the probability of expiring cone at one standard deviation. 68% probability, one standard deviation. And it draws that on the chart. So now what we're going to do is we're going to watch this. We're not going to manage it. We're not going to take it off. I'm not going to put a stop on it. I'm willing to accept that maximum theoretical loss because what I know is, even though that's a larger maximum theoretical loss than I could make, the likelihood of me taking that maximum theoretical loss is very low. My probability of taking that maximum theoretical loss is about 15%, theoretically, maybe even a little bit less than that. Doesn't mean that it can't happen, because it can and it does. We've had it happen, but this is a higher probability trade. So that's what we're going to do. And then we're just going to watch it until 7 DTE and take the trade off. That's it. That is it. That is the plan right there. Sell a vertical spread at 14 days, buy it back at 7. If price is above the 200 period moving average, sell a put spread. If it's below the 200 period moving average, sell a call spread. 14 days out, draw a line at 1 standard deviation, sell that strike price, buy one 20 points wide from there, and let that trade take out. It was pretty close to that. I was kind of, I'm not being too particular, not too precise. You could go to the 67.7 or the 65.70. It's a little bit lower probability even, or a little bit higher probability even still. Yeah. So koala, the reason I always draw that line, I could simply say this. We could simply abbreviate this and say buy or sell the 15 delta. But that's not always going to be the case. If implied volatility is higher or lower, that's going to be a different place. And the reason that I always draw that line is because I'm establishing consistency in how I establish this strategy and do this trade, so that you can see this time and time and time and time again for how we're doing this. So is there a specific range for this or name for this strategy? No, there's not. Not that I know of, other than I call it the 14-7 strategy, but that's it. Now, here's the other thing that this does, and I'm not going to have time to go deep into this, but I just wanted to illustrate this and talk about this for just a second. One of the reasons why we're doing this, why we're doing 14 and 7, and with a far out of the money option, okay, with a far out of the money option, is because that time decay curve that we're always used to seeing, this one, right? If this is expiration here, this time decay curve is the at the money curve. But we're not trading an at the money option, are we? We're trading an option that is out of the money, far out of the money. So the time decay curve for a far out of the money option, if this is expiration, again, right there, the time decay curve for a far out of the money option, OTM, which is what we're trading, looks like this. Most of the time decay happens in the first section of that trade. So selling at 14 days, buying back at 7 takes advantage of that rapid time decay in the beginning of the trade, as opposed to waiting for that time decay to happen. So if you want to learn a little bit more about that time decay relationship, let me do this. I just want to pop back out here, and I want to come over and we'll go right click, and I'm going to pop you out here and theta. I did this yesterday in the long verticals. It wasn't that one. Here it is. Time enough for trades. This one yesterday. Getting started with options, the importance of theta. I talked through the relationship of moneyness, being in the money, out of the money, versus the rate of time decay. So if you want to find that one, just type in the word theta and you can find that particular webcast. When you're here, click on that subscribe button. And if you want to go over here to the Schwab coaching page, schwab.com/coaching, that's where you're going to find the calendar for the in-person events, the live webcasts, and so forth. So what we're looking for is next week, we're going to buy this one back and we're going to sell another one. We're going to see how much of it we get to keep out of that $1.90 that we sold this, or $1.70 that we sold this for. Yeah, theta is going to work on the weekend. You can do this any day of the week. I just do it because Wednesday is the day that I teach this particular webcast. There's nothing magical about Wednesday, and there's nothing magical about Fridays. It's just do it when you can do it. So once again, my thanks to Barb Armstrong for helping out. My thanks to all of you for being here. and helping me to walk through an understanding of index options and why we talk about index options and why we use some of the strategies that we do. My thanks to our great producers and our reviewers. We'll see you guys again here next week. Take care, everybody. Bye-bye.